Wonderful. Thank you so much, Kevin and Mark and everybody over there at Real Traders Webinar. You guys do an amazing job. You really provide a fantastic service to the trading community, and really the best I've seen. So just have to really give you guys kudos on that. You are providing an amazing service for people to be able to have access to so many different approaches to trading and the best of the best of the best. So yes, I have titled titled this webinar with the very succinct title of Solving Your Trading Psychology Challenges, Simple Tips to Dramatically Improve Your Trading Discipline, Remove Fear and Hesitancy, and Trade with Confidence and Consistency. All right, so let's jump right into it. I have actually some great stuff for you today. And by the way, let me just also preface this entire presentation by telling you I have nothing to sell. So if you want to buy something from me today, that's just really too bad because I have nothing to sell to you right now. This is all going to be good, free, quality content. Going to get into some very specific things, not just some generalities. When I talk about overcoming your trading psychology challenges, we're not just going to be talking about positive thinking or how to think about things. I'm actually going to give you two very specific exercises in the next hour that you can take and you can use. And I've also got some freebies here that I'll be sharing. So yeah, this is going to be fun. I love doing this. I haven't done this particular topic for quite a while, and yet it's actually one of my specialties. So let's jump right in. There's my ugly mug. Well, you've already heard about me a little bit, so I'll go through this line real fast. Yes, I did write Trend Trading for Dummies, been a Reader's Choice Award winner for many years, written several or participated in other books, write for and train traders at different exchanges and software programs and brokerage firms, etc., etc., etc. Okay, there we go. Now, let's make the most important person in our lives happy. And I think we all know, once I say that, who we're talking about. The most important person in all of our lives, the person that's dearest to our heart, the person that brings warm, cuddly feelings into the inner sanctums of our soul, the person that we would lay in front of a truck for, the person we would take a bullet for, the person who is just, so precious, our dear, loving, kind-hearted lawyers. So let's make sure that we make them happy. Yay, lawyers. All right. So, sarcasm? No, I don't know anything about that. But what I do know is that we got to cover these legal disclaimers, and a lot of people go through these really fast just to meet their legal obligations. I'm a little different. I'm doing that, obviously. But I'm also going to tell you that, all joking aside, this is actually very, very important, because it's not just the legalese. This is where your trading education begins. It's very important that you come into trading, or even if you've been doing it for a while, and you do it realistically. You have your eyes wide open, you know what you're in for, and that's what this is really all about. In fact, that's what these legal statements are here for. They're to protect you, because they've come out of some really bad situations where people got hurt, lost a lot of money, and that's why these issues have come up. So the fact is, trading is simply not suitable for all people. Not everyone's going to make money, not everyone does. Some markets are leveraged. Talk to your broker. They can see what you're trading, how much margin they make available to you, and know what your maximum risk exposure is. Very, very important. One of the major differences between amateurs and professionals is professionals, we really focus on our risk management. Please, dear Lord in heaven, only use funds that you can afford to lose. We call that discretionary money, and that fits within your overall financial plan. All information in this presentation is for educational purposes only. I'm not going to be giving any specific buy or sell advice, so please don't even ask me for that. The use of the information in this presentation is at your own risk, for general purposes only, and we assume no responsibility or liability for errors or omissions. Okay, well, fortunately my lawyer's not here right now, but if he and she was, because I've got lawyers up the wazoo, they protect me, and that's great. They'd be, well, I wouldn't say they'd be smiling. They never smile, but at least they wouldn't be frowning. Okay, so let's jump into the meat and potatoes. What moves the markets? When we talk about trading psychology, we're going to start out today at a place that maybe you didn't expect. We often think of trading psychology as what's going on in our individual minds, and certainly we are going to talk about that. I'm going to give you practical exercises to help you with that. But before we get that far, I want to set the stage here and put this into the context of the psychology of the markets themselves, because there's an intersect between the psychology of the markets, the mass psychology, and our individual psychology, and I'm going to demonstrate that intersect for you. So, what really moves the markets? Okay, what moves the markets are, well, what? Fundamentals? Do fundamentals matter? They do. My dad, as you heard, he was a trader. He traded stocks, and he focused on fundamentals, and he did very, very, very well. The problem for me, I don't really focus on fundamentals very much, and now when I'm investing long-term, I will look at that. But for trading, day trading and swing trading, I don't really look at that very much. And part of the reason is, well, there's several reasons. Yes, insider trading, Frank says, book cooking, you know, we've all seen the scandals in recent years, right? So that's one thing, is you just can't really rely on the numbers all the time, unfortunately. So that's the thing, is are the numbers even accurate? Number two, the Dow theory of discounting the market. What is that theory? That means that the professionals are discounting, meaning they're not waiting until all the numbers are obvious and the earnings are out and all that kind of stuff. Once everything's obvious, the game is done. The pros have moved on to the next game. So I actually got this question yesterday from a trader asking about how come when economics, you know, say one thing and the market does something totally different. That's because they are not, it's not that they're not aligned, they are aligned, but the market leads the economics. And that's what traders are always trying to do. Now, another thing that's weird is sometimes the market will go up on good news and down on bad news. Well, that's not weird. That's what you would expect. But then other times it does the opposite. It goes up on bad news and down on good news. So again, these things of looking at the fundamentals, economics, numbers, all this kind of stuff, it has its place, but traders are not really trading when everything's obvious. They're trading before it becomes obvious. That's why they used to call it speculation. I still like that word, even though that's an old-fashioned word back from the days of yore with Jesse Livermore. But I still like that word because it reminds me of what we're really doing. So that's the problem with fundamentals, is the markets don't always do what they're supposed to do. So what really does move the markets? Do these numbers move the markets? No. People move the markets. I mean, really, what are the markets? Literally, they're just a huge auction place, a global auction place. That's what they actually are. So the markets move based on people's beliefs and feelings. Lots of people. So as I said, the markets are about mass psychology, not individual psychology. And for this reason, I focus on technical analysis rather than fundamental analysis. Because technical analysis is chart reading, and I can look and I can see what's really happening. Fundamentals, you look at that and you try to extract what the market should do. In other words, what the masses should do. Should they buy? Should they sell? What's logical? Well, technical analysis looks at what is. Not what people should do, but what are they actually doing? And the charts show you that. In fact, the charts are a map of math, or they're the math of mass psychology. And that's what technical analysis is. Then the charts are a map of mass psychology. So the charts don't lie. They just show you what is. Again, how people are actually responding to any numbers that come out, any valuations, earnings reports, whatever, and what people feel and believe about those numbers and about the news. So what's the nature of the market? Well, the movement of the market is the movement of mass psychology. What moves the market, what creates these higher highs, higher lows, all these different things on charts, are people's buying and selling in mass. So the nature of the market is human nature. Now, obviously, we can talk about computerized trading, and yeah, oh, heck yeah, it's dramatically changed trading. I've been trading, well, my dad started teaching me when I was 8, and I'm 56 now, so been around for a little while. We didn't have PCs back in those days, so I've seen a lot of changes in the ways that markets move. And yes, computers have had a huge amount to do that. In fact, over half the volume traded on the New York Stock Exchange today is through computers. It's not now we say computers, and that's true, but you got your logarithmic trading, got your high frequency trading, of course, and then you got your individuals and institutions that place trades. But remember that even program trading, who programs those computers? It's people. And they're doing that based on their theories, their beliefs, their principles, whatever ideas they came up with. They're just mathematically programming that into the computer. That's number one. Number two, a lot of people seem to think that, oh my gosh, computerized trading is great. I wish I had, that trading system from Goldman Sachs. Well, you're never going to get it, and it's not going to be sold as a Forex robot on eBay. So forget about that. That's not a comparable thing. Those big, huge brokerage firms, institutions, and so forth, they wait outside the doors of the Ivy Leagues, MIT, and grab those PhDs with mathematics as they come out of the graduation hall and give them millions of dollars. Can't compete with that, and you're not going to. So we got to play a different game. And in trading, there's so much information. There's so many angles you can play, and you got to find your niche. And the good news is you don't have to be overwhelmed by all the information because you don't need it all. You just need to find your little niche where you're comfortable and where you can find an edge. So you're never going to compete with the high-frequency traders. You're not going to compete with the logarithmic traders. But the good news is you don't have to. All right, and by the way, here's the other thing. All those computerized programs, do you realize most of them don't work anyway? I'm talking about even the professional ones. So don't get too enamored with them. If you look at the statistics, you'll see that they might be short-term successful, and then all of a sudden they stop working and the companies have to come up with new ones. So don't think that just because some big institution's using a computerized trading program that it's working for them. That's a misnomer. That's a misunderstanding, I should say. Okay, so as I said, charts are maps of collective human behavior. Now, I include the computer programs in there because, again, it's behavior. It's what's actually happening, whoever actually executes the trade, whether it's a human hand or a computer program. So if the market isn't like people, it really is people. Nothing gets plotted on a chart until people take action. I'm not really big into, the SOS bandit. I'm not big into following bids and asks. I've sat next to friends who trade 100 lots on the E-minis, and I've seen them put in their bids, their asks, and then pull them at the last second. I've seen that with my own eyes. So I'm only looking at what people are actually committing to, the actual buying, the actual selling, the actual action. Again, actions speak louder than words. So where's the commitment of money? And that's why I like charts. They don't map people's thoughts, beliefs, hopes, fears, all the stuff that they're talking about on all of the financial news networks and everybody's theories and ideas. No, charts map people's commitments, where they put their money where their mouth is. So now, that's the nature of the market. It's really human nature. So then, what is human nature? Well, let's talk about that. Let's start bringing it from the mass psychology into our individual psychology. Well, people are goal-oriented. We all function, our life is one big trend. We start out as babies, and we have a goal, and several goals, actually. Number one, we want to start moving. We got to get mobile. That's actually a defense mechanism, a survival mechanism. Then we're going to learn to feed ourselves, right? And we progress all the way up through getting married, getting a job, getting security, having children, all that kind of stuff. So our lives is one big trend. Now, our lives as a trend are not smooth. So it's not just a straight line from birth to death. There's a lot of wiggles, right? It's a lot of messiness. And that's why we even have this famous saying, 3 steps forward, 2 steps back, because that's what life is. So you make progress, but on the way to making progress, you're always hitting these speed bumps. So we call those oscillations. And then sometimes we don't even oscillate. Sometimes we just, gol darn, get stuck. And the trend stops, and we just are, I'm stuck in a rut. I'm stuck in this job that I've been here for 20 years. I'm not making any progress. Stuck in this relationship. I'm not making any progress in my relationship. Whatever. We've all experienced getting stuck in our lives with one thing or another. It's also very natural as a human being to experience cycles. In fact, our whole being is a series of cycles. The very respiration Your inhaling, your exhaling is a cycle. Your heartbeat is a cycle. We stay awake during the day, most of us. I stay awake at night too. Sometimes I like to trade the DAX market sometimes. And then anyway, and some of the Forex markets. But most people, normal human beings, they are awake during the day and they sleep at night. That's a cycle. And that's a normal cycle. But then, like when I was in graduate school working my master's and then later on for my PhD, I would pull all-nighters before finals, midterms, big papers. I would stay up 2-3 nights in a row, and then I would crash, go on vacation. Those are expanding and contracting cycles. I've got another webinar on cycles that's fascinating. And there's many different types of cycles, but cycles, even of themselves, like trends, are not symmetrical. They're not just nice, evenly spaced sine wave type patterns. Cycles expand, they get long, and then they contract a bit. And that's just like human nature as well. And human beings, every psychological study has shown, we are primarily emotional beings. We love, we hate. We overreact, and we get passive aggressive. And we're certainly not always logical. In fact, the psychological studies show that even though, especially in the West, this is more of a Western phenomenon, we like to consider ourselves logical, and we do, because that's the value of the West. The truth is that most of us actually make decisions based on emotion and justify them with logic to help us feel good about them, because that's what we've been told how you're supposed to make decisions. Also, studies have shown that people who make emotional decisions often make better decisions than those who make logical decisions. Did you know that? Very interesting research on that. But the truth is, we are primarily emotional beings above logical beings. Therefore, we also need to look at that in the markets. When people say, well, this market doesn't make any sense, correct. It does not. Do not expect the markets to make sense. Do not expect them to be rational. This is why when people create computer systems, they so often don't work, or they don't work very long, because they are creating logic-based computerized programs and trying to apply them to a market that is basically and often a random walk down Wall Street. Chaos. All right? So, what about me? Okay, that's the markets. That's other people. That's the masses. But what about me? Let's bring it down to the individual level now. Well, you know Plato's principle, right? The 80-20 rule. That applies to trading as well. Approximately 20% of the people make 80% of the money. All right? So, right away we come into this game, as I said earlier, with your eyes wide open, knowing most people lose money trading. Now, the good news is, and each one of us can say that for ourselves, I think I'm going to be different than the masses. Well, of course I do. I wouldn't be trading. If I thought I was going to be one of the masses, I wouldn't even trade, because the masses lose money. So obviously I would only participate in this business if I thought I was going to be one of the few, the unique, the special ones, one of the 20%ers. Now here's the bad news. Guess what? Everybody who's trading thinks they're going to be different than the masses. We all think we're going to be, 100% of us believe we're going to be part of the 20%. Therefore, just the fact that you think that means that you think exactly like everyone else. You think just like the masses. You have that mass psychology. That's bad news. Because why? Because the masses lose money and you're thinking just like the masses. Wow. Now that's a brain twister. Okay, that is what the Chinese call, in Chinese philosophy, Taoist philosophy, they call it an iron circle. Some people would think it's circular thinking. That's not an accurate translation of the philosophy. An iron circle is where you are locked into a paradigm, actually. And there is no way out of that way of thinking other than to transcend the circle. You can't even play the same game. You have to abandon the circle, actually. So here's how we get out. How do we get out of that? How do we get out of being one of the masses whose mindset is the same, who think the same way, and that type of thinking is exactly what makes us lose money trading. So we can take this and we can use it to our advantage. And this is what I've done, and here comes our first exercise. You may even want to get a pen and paper and write this down. It's kind of a informal biofeedback technique. Okay? Here it is. So, and I've actually done this. I got this idea, and then I put it into practice, and it was amazing, changed my trading life. So here's what I did. I attended a lot of free live trading chat rooms where traders are actively communicating with each other. Now, very important that the type of chat room you get into is the kind we want. Ironically, what we don't want is we don't want to get into a chat room where there's a professional moderator. We don't want to get into a chat room when there's actually somebody who knows what they're talking about. Okay? I know, it seems kind of counterintuitive, but you don't. Not for this exercise. Okay, it's good to do that, but not for this exercise. That's all. This exercise is unique, has a unique purpose. So you're looking to get into a chat room where people are actively communicating and they're talking to each other, but it's basically the blind leading the blind. All right? And then what you want to do is listen and watch the charts that they're commenting on. Pull up the same charts they're commenting on and watch the charts in conjunction with their comments. Now, remember, the masses are wrong most of the time. So what you're hearing in these chat rooms, this chatter, is the inner dialogue, and then watching on the charts the corresponding behavior of the losers. And that is powerful. That is powerful to observe. In fact, one of my mentors many, many years ago, he used to have this slogan. He would say, Barry, here's a chart, find the loser. And it was kind of a play on that old puzzle, Where's Waldo? Guys, remember that? I haven't seen that for a while. Where's Waldo? And he was kind of playing with that. Find the loser was his slogan. He just showed me a chart, said, find the losers. And he didn't really mean it in a derogatory way. He just meant losers in the literal sense of the term, people who are losing money. And I didn't really understand how to do it back then. I never figured it out from him. But I figured it out this way. This is how I figured it out. So I would do this. I would listen to their comments and watch their charts. Listen to their comments, watch their charts. And of course, they're losing money like crazy, right? But you have to do this for a period of time. Repetition is the key. I did it for about 6 months. Listening to their comments, watching the charts. And before long, guess what? You can start to do the opposite. You'll start to be able to look at the charts, and even without the chat room open, you'll be able to start hearing what those guys are saying in your mind. Why? Because your brain has heard it so many times through so much repetition. What you'll find out is that people repeat the same mistakes over and over and over and over, and you will hear the people doing the same thing, the same wrong things over and over and over. So with that repetition, pretty soon you start to look at a chart and say, oh, I know what the chat room is saying right now. Okay, now let me give you one example of that just to put a little bit of specificity to it. So one of the most common patterns was when the market was on a tear, when it was in what I call a mega trend. So the market would be making higher highs, higher lows, higher highs, higher lows. And at some point, somebody inevitably would chime in and say, okay, well, this market is way overbought. This thing is, oh, and another common, the terms they would use would be overbought, and the other term that I would hear a million times was toppy. This market is toppy. Oh my gosh, if I heard that once, I heard it a billion times. And so they say, I'm going short here. This market's way overbought, and it's toppy. I'm shorting. This thing can't go any higher. You know, and they'd have whatever, they'd have their reasons, their logical reasons, you know. Average true range is way out of whack, the volatility is crazy, you know, Bollinger Band, Keltner Band, whatever. Candlestick patterns, they'd all have some reason to validate it. And you can probably guess, you know, because of the context of what I'm saying here, what happened next. The market would come down, they'd get filled on their short, and the market would go down very little and then turn right around and make another higher high. Well, great. So then they got stopped out. Well, then there'd be some disgruntled little, you know, humorous comments they would make, and then the market would continue going higher and higher, and finally they'd say, okay, now that's it. Now the market is ridiculously overbought. I'm shorting here. I'm going all in short. I'm going to make a ton of money. This thing's so toppy, it's crazy. And another phrase they would say, it just can't go any higher. It can't go any higher than this. Man, when you hear that, oh, you know the market's going higher. If they say it can't, oh, the market can do anything it wants. In fact, one of my favorite sayings is the market can do anything at any time. And believe me, it can. So never tell the market it can't do anything. It will pummel you. It's just waiting for you to say that. So the market, I like to say that the market is a wild beast, and you will never tame it. You will never tame it. The best we can do is tame ourselves, and that's what this webinar is all about, because you cannot domesticate this wild tiger. The market's not a purse puppy and never will be. It'll always be wild. So anyway, that's one of the most common patterns, and usually what would happen is that would happen about 3 times, and they'd get stopped out every time as the market made higher highs, every time they said it couldn't, and finally they would end up and they would say some colorful words, and that's it, I'm going to play golf. This market's crazy. And they would leave. And I'd come back the next day, same thing would happen. Same thing would happen. Same thing would happen. These people would keep making the same stupid mistakes. Guess what? I'm not criticizing them because you know what? I've done that too. I've made that mistake not once or twice or 10 or 50 times. I've probably made that mistake 100 times in my decades of trading. And there was something special, though, about watching other people do it. I guess you have more of an objective viewpoint. And I saw myself in them. And I said, wow, I do that too. That's not good. That's not a good way to do that. That is not a winning strategy. All right, so that's just one example. Now, if you decide this is quite a commitment, obviously, but the rewards are huge, huge, because then you'll be able to take and you'll be able to see your own amateur behavior. I call that amateur behavior. Be able to see your own amateur behavior in other traders, and it would be beneficial for you. Now, great book, very famous book. Most of you know this book probably already. For those of you who don't, I highly recommend you read the book Market Wizards by Jack Schwager. He has a series of them now. But originally he started out interviewing some of the world's most successful traders, and the purpose of it was to find a commonality among the most successful traders to lead to success for others. So at the end of the first book, he interviewed all these people, and he was looking again, what do these great traders all have in common that we can learn from? And here was his conclusion. What set these traders apart? Most people think that winning in the market has to do with finding some secret formula. The truth is that any common denominator among the traders I interviewed had more to do with attitude than approach. And I can vouch for that. You know, I've made a lot of friends in the trading world over the decades, and I got friends who trade all kinds of different approaches, and they make money. Now, some of them I'm not comfortable with. They just don't fit my personality, but I'm not going to criticize them. Hey, they're making money. That's great. But the one thing that all people do have in common that I've come across is the attitude, the psychology of trading, the disciplined nature. Now, he had a follow-up book, well, actually many follow-up books, but the next follow-up book was called The New Market Wizards. And he said, when asked what was important to success, the market wizards never talked about indicators or techniques. See, that's what amateurs focus on. I don't use any fancy schmancy stuff on my charts. My charts are very simple, very clean, very plain. I don't use any proprietary indicators or anything like that. I mean, there's some good ones out there, but you know, I just don't. I just keep my stuff very simple. And he said the market wizards never talked about indicators or techniques. They talked about things as discipline, emotional control, patience, mental attitude toward losing, huge. The message is clear. The key to winning in the markets is internal, not external. Absolutely. So it's obvious that to be a successful trader, you've got to have a viable trading method, setups, rules, and a plan that works. Yes, you do need that. I just want to be clear. I'm not diminishing the importance of that. In fact, that's actually primary. You've got to have a viable trading methodology. Otherwise, no amount of psychology is going to help you. If your method is faulty, you can be very disciplined, but you're going to be disciplined with a losing method. So obviously, that is not going to work. So the method comes first, but you know what? There's a lot of people out there who have a viable trading method, and they don't even know they do because they're losing money with it. And that's the thing. So they've never tested their method divorced from their emotions. So for this reason, I highly recommend when people start trading any new methodology, they trade it on paper. Even if you're a seasoned trader and you're trying a new method, still, with that new method, paper trade it, or better, use some kind of simulator or demo account, and do that for at least 3 to 6 months of day trading if you're a day trader. And do that without risking any money. Why risk money until you have confidence in your method? So this type of approach where we are using a simulator or paper trading gives you the benefit of helping you learn the timing of your entry. So critical, timing. Oh, I've got another whole session on that, tutorial on that. So learning to enter your orders without hesitation is critical. It's critical trading behavior for your success. And you'll also learn if that trading method fits your personality. So keep track of your trades for 3 to 6 months without the emotion of money involved. Because before you can trade successfully, you've got to have confidence in your method. And you can't have confidence in your method until you've tested it, divorced from emotion as much as possible. I don't think you can do that perfectly, but as much as is reasonably possible. Then, when you get started actually trading with real money, just do it with a small amount of real money. Take baby steps so that the emotion of real money is not impacting you so much. Because believe me, when you start trading with real money, you will notice a difference in your behavior, and that's why we take little baby steps with it. So overtrading is one of the biggest challenges. In fact, I'm raising my hand right now. That was one of my cardinal sins, was overtrading. That's the one that was hardest for me to break. And what I've learned, and as I've sat down with traders and my mentors in the past, is they actually traded a lot less than I thought they did. They wait for the perfect setup because they know that that's the only time the odds are really with them. That's the only time they have an edge, and that's the difference between trading and gambling. Even gamblers know that. You know, I like to make an analogy or a comparison with poker players, and I'm not a poker player, but I know some who are, and I've met some professional poker players and have talked to them about this. And professional poker players, they will fold more hands than they play. Did you know that? They fold more hands than they play. And professional traders are the same. They will trade a lot less. Now, we actually have an advantage. We don't have to ante up. So we can sit there and just wait for the perfect setup, the ones that really is on our side. Because every loss is more damaging than you think. It takes a lot to make up for a loss, right? If you lose 50% of your money, how much money do you have to, or what percentage of that do you have to get back to even? 100%, right? So those losses are just killer. Now, here's one of my favorite books in the world, and one of my favorite quotes in the world. And this guy is quite a character, so I'll warn you about that. But if you're interested in the psychology of trading and money management and all that kind of stuff, one of the best books is not a trading book at all. It's called Money Management for Gamblers by John Patrick, and he's a professional poker player. And I will warn you that he's a little colorful in his language, but I find this applies to traders beautifully. He says, people who are way better educated than me ripped my theories from here to Hades and back. They claim that gambling is all about math and statistical analysis. Okay, let's stop right there. Now, doesn't that sound like a lot of people in the trading world who say, oh, it's all about putting together a nice mathematical system, back testing it, out of sample forward testing it, and all that kind of stuff? See the parallels? Then he says they will never grasp the true meaning of gambling because they've never been there. People who think that a math equation is going to give them a leg up on winning ought to have that leg whap them in the area where they sit on their brains. The pros don't make mistakes. Now, that's my emphasis. I capitalized mistakes because we're going to get to that in a minute. The pros don't make mistakes and they don't have tells. Patience is a virtue. There's that word. Patience, waiting. Stupidity is a one-way street to disaster. Talk is minimal and mercy is absent. By the way, when I was at the CME, I had a mentor who was a floor trader. I got an apartment out there. Let me tell you, if you want to go to a place that was vacant, a vacuum of mercy, it was the CME back in its day. Now, it's totally different now. Most of the pits are closed. But, oh my gosh, that's a whole nother. I loved it, actually. It was fun because, to me, it's like, great, everybody's here to do business. And they were. They were. There's some very friendly people, don't get me wrong. There's some nice people, too. But when it came to trading, when it came down to the money, oh, yeah, it was the jungle. Make a mistake, and 7 vultures circle the wagons, waiting to divide the spoils. When the night is done, and you are fortunate enough to escape with a small profit, the ride home gives you only a short time to count your blessings and your money. Oh my gosh, does that describe trading or what? Absolutely. So if you're not trading well with this successful methodology, it's most likely because you're making mistakes. So, big question, is there a way to eliminate mistakes? Well, the answer is yes. Now, no one ever becomes a perfect trader, but I'm going to share with you how to start reducing your mistakes. Okay, so this is going to be exercise number 2, and this is uber powerful. Uber powerful. This one thing alone, when I used to do personal mentoring, I would do this with my students one-on-one. So this has been tested with many, many traders individually, live, and in person. And it has turned around so many people's trading accounts, I can't even tell you. And what I'm saying is people were losing to being successful. That dramatic, this one thing. All right, so highly encourage you to do this. Again, is it going to be some work? Oh yeah, it is. None of this is for the lazy person. Traders are not lazy. Successful business people are not lazy, and trading is a business. And you know, one of my favorite quotes, I think, is from A.L. Williams, although I've heard it quoted so many times that I'm not sure who originally came up with it, but I first heard it from him. And he said, successful people do what unsuccessful people are unwilling to do. There, the operative word is unwilling. I love that. Can the unsuccessful people do it? Yes, but they're unwilling to do it. They're unwilling to do. Sometimes it's because it's mundane or repetitive or hard, or they just don't feel like it. Well, that's the difference. It's not talking about doing something that's that complicated or challenging. Sometimes it's the things that are just the mundane. So anyway, here we go. Okay, exercise numero dos. So what we're going to do is we're going to identify our mistakes, and then we're going to work to eliminate them. So to identify your mistakes, I have created a list of what I call my 10 commandments. These are general rules for trading. And then I translate those into mistakes. In other words, breaking these commandments means making a mistake. Now, I'm looking at the clock, and I realize that I'm not going to have enough time to go through all 10 of these. So here's the first 5. Memorize them. Got it? Good. Okay. Here's 6 through 10. Memorize them. 5, 4, 3, 2, 1. Got it? Good. Okay. So now, all right, I'm not going to do that to you. Send me an email. I don't have time to go through them because I want to make sure that I respect everybody's schedules here. I know we're all busy people. So what I'll do is I will email you these, okay? Just send me a quick email. You don't have to opt in or anything like that. Barry at, topdogtrading.com. There, I just typed my email address into the chat box. So if you email me at barry@topdogtrading.com, ask for the 10 Commandments document. It's a PDF, and I'll just attach it to an email and respond and send it right back. And then you'll have it in writing. These are the top 10 most common mistakes that I've seen traders make. Both myself, my own mistakes that I admit to, that I confess to, as well as students that I've worked with. So I've got a lot of experience and a lot of people that I've been able to garnish, the most common problems. Now, this is just a starting list. This is kind of your springboard, and you start here, and then you can add your own list. So one of my favorite sayings is successful trading is simply a matter of not making mistakes. And I have found this to be a great truism in my life. As long as I don't make mistakes, I come out at the end of the week or the month in profit. So again, those 10 commandments are the mistakes I'm referring to, and you might have some unique ones that aren't on that list, so you kind of have to get to know thyself. And that's okay. So you can add to it or you can subtract to it. The goal is not to be perfect, because you never will, but to trade your method as strictly as possible without making any of these mistakes. So you're avoiding mistakes as a matter of self-discipline. Now, by definition, I can't give you, no one else can give you self-discipline. But what I will give you is an exercise that'll help you with the issue. If you stick to it, then this will work for you. Okay, so here it is. And again, by the way, when you ask for that 10 Commandments, if you want that, I'll send you this form as well. And this is the form that we use to help eliminate mistakes. All right, let me bring up my little pen here. And by the way, I'm going to give you fair warning that I am a lousy artist, so I'm drawing with my mouse is even harder. Okay, so this is my trading log. Everybody's got a trading log, and it might seem kind of mundane at first. Well, you know, your broker can give you most of the information, like what day is it, right? Your entry time, what you're trading, the price you got in, the prices you got out, all that kind of stuff. You can get that from your broker at the end of the day or at the end of the week or at the end of the month. So that's not the point. Okay, we don't have to really focus on that. Here's what we're going to focus on. These areas down here. So we can put 3 trades per page. Now, the 2 most important parts here are this area here, this gray area, notes. What you're going to put there are 2 things. Number 1, when you took the trade, what were you thinking? Okay, I'll just put a T for that. What were you thinking? And number 2, what were you feeling? Now, when we talk about thinking, what I want you to put there is, if you could put even any actual words down, like we were talking about in the chat room, the amateur chat rooms, like, oh, this looks toppy, you know, or this looks way overbought, that kind of stuff. Whatever thoughts were going through your mind, write down. If you can get actual words, it's really great. And not just ideas, but actual words is the best way to do it, because you will find that you were saying the same phrases and using the same words over and over and over and over, and then you'll find in time, whenever you're thinking those words or phrases, it's going to be bad for you. It's amazing, but it really does work. Okay, so you put down your thoughts and your feelings. How are you feeling? Were you feeling anxious? Or were you feeling confident? Funny, but sometimes people find that when I feel the most confident about trades is when I lose. Yeah, sometimes a very, in fact, I have an article I wrote a long time ago, and gosh, it's been years now, but it was called Good Trading Must Be Unnatural. Good trading must be unnatural. That's another whole topic. All right, I get carried away. I got so much I can share with you guys. I just love doing this. So that's where you get your kind of your biofeedback there, all right? So again, it's kind of a similar thing with the chat room, except instead of from other people, now you're getting it for yourself. What are you thinking and feeling? And you watch this over a series of, oh, maybe 50 to 100 trades, and you'll start to see patterns, so that then when you go to take a trade, you'll start to observe your own thoughts and feelings as you're taking that trade, and you say, oh, wait a minute. Every time I say in my mind, oh, this looks toppy, I always get stopped out. I'm not going to take this short. Just stay by. It's going to be hard, because why? Because it's a habit. We've created habits. You got to sit on your hands real hard, and then sure enough, you'll see all of a sudden, oh man, if I would have taken that, I would have lost money. Thank God for Barry Burns. Oh, thank you, Barry. I'm going to send you some Dom Perignon this Christmas. Okay, so anyway, I actually got a guy who does that every year. So anyway, then we go to number 2, okay, the yellow box. And this is where you put your mistakes. Now, here's where you go to that list of 10 commandments or any other common mistakes you have. So common mistakes are like getting out too early. And you'll say, gosh, you know what? The market keeps going, and I get out too early. I don't capture, you know, most of the move in a trend. I'm always getting out too early. Or I'm getting in too late. That's another one of the 10. You know, I'm hesitating. So by the time I get in, oh man, I should have gotten in, you know, 5 points ago, and now the market's already taken off. My risk-reward ratio is screwed, or I should say skewed, which is pretty much the same. And so, you know, those are 2 common things. Overtrading is another one. Not waiting for the best setups is another one. So anyway, you'll list it here. So let's say that it is getting out too soon. That's a common one. Okay, so we say getting out. We'll say go. That's really a bad 0. Looks more like a broken square that just got kicked in the butt. All right, so getting out to, oh my goodness, this is why I never even applied to art school. All right, getting out too soon. And so maybe that's what you did there. Maybe that's what you did there. Maybe that's what you did now. You might have made more than one mistake. Maybe you got in too late and you got out too soon. You put them both there. All right, so you guys get the idea, right? That's what we're doing. Again, be happy to send you this document so that you guys can have it printed out and use it yourself. That's what this is for, is to help you. Now we take it one step further. Okay, that's the process. Now, here's how this is going to help you. You've got to do one more step. Now we take it to another trading log, but this one is a weekly trading log. So now each one of these rows is a week. And we're going to summarize each day. Or I'm sorry, each one of these rows is a day, and this will cover the week. 5 weeks, 4 or 5 weeks to a month. Okay, so this will be, and this is for day traders. Obviously, you can adapt this for swing trading or even investing if you want to. So this would be one day. That'd be day 2, day 3. So maybe Monday, Tuesday, Wednesday, Thursday, Friday. Okay? And then you get your weekly totals down here, totals for the week. So here's your win-loss ratio. How many wins did you have this day? Maybe you had 4 winners, and should we be nice? Yeah, we'll say 2 losers. Okay, not bad. Now, P&L. So that's your win-loss ratio. That's the first ratio you look at with trading. There's 2 primary ratios we're concerned about. Then the win-loss ratio, which how much did I make on my winners? Okay, so we put in whatever it is there, and then whatever dollar amount. These are dollar amounts. Total dollar amounts of your winners, total dollar amounts of your losers. Now here, I'm going to then divide this number by that number. So here's my average dollar amount winner. Here's my average dollar amount loser. What is this? This taking down to here, my weekly total, that'll give me my risk-reward ratio. We always hear people talk about, oh, well, don't take a trade unless your risk-reward ratio is 3 to 1. That's great if you have a crystal ball in front of you, and that is desirable, obviously, but you got to take it to another step. Nothing wrong with that concept. In fact, it's a great concept. But what we need to know is what is your actual win-loss ratio? And that's what you're going to learn here. Not your hypothetical one or what it should be. What is it actually? Here's your actual win-loss ratio. Here's your actual risk-reward ratio for your trading. Now we got to look at commissions. Here a lot of times, and then we go to net after commissions. This net P&L, that's your profit or loss dollar amount after commissions. So that's how much you made net that day or lost that day. And then this other half here is percentage of your account. So what percentage of your account did you go up or down that day? Very important, because part of our money management plan is we say we will only allow ourselves to lose a certain percentage of our account on a daily basis, weekly basis, monthly basis, quarterly basis, and annual basis. That's a stop loss. A stop loss for the day, a stop loss for the week, stop loss for the month, stop loss for the quarter. So once you hit your percentage of your account stop loss, you have to stop for the day. If you get beyond that, then you are knowing you're making a big mistake. Okay, now we go from the daily log and we add up all the mistakes we made, just the pure number. Just the pure number. Maybe you made 10 mistakes that day. Then, this is where it gets really interesting. Then you say, okay, so here's what I made or lost that day. Now, what would I have made or lost if I did not make any mistakes that day? So you basically take all your mistakes and you subtract them off of your daily trading logs. And what then, if that was the case, what if you didn't take those trades that were mistakes? What would you have made then? Now, this is a huge motivator. What happens is, day after day, week after week, month after month, you're going to compare these 2 columns here. That one with that one. That one with that one. You're going to see this one is always bigger than that one. And here's what happens with a lot of people. They start to see that, ye doggy, if I were just to stop making these stupid mistakes, I'd already be a profitable trader. In fact, I am a profitable trader. I'm just a profitable trader who's making mistakes and therefore losing money. But my good trades we're not all, you never get 100%, but if I was not making mistakes, I am a profitable trader. So I don't need a different indicator. I don't need a different this or that or anything else. All I need to do is stop making mistakes. And this is very true of a lot of trading. Is it's not, amateurs are always trying to add stuff. Usually it's subtracting, it's simplifying. And you know, that's where the real success comes from. And this is what motivates. This is what gets you to change your behavior, is seeing the difference between those two numbers. And remember, that's just for 1 week. Now you see the same thing the next week, and then the next week, and then the next week. And pretty soon you get sick of yourself, and you start to say, well, dang it, now I'm mad at myself because I'm making money if I just stop making these mistakes. And for many people, that's the motivation they need, is to see those numbers. This is like, it looks like a piece of paper. It's really a mirror. It's a mirror reflecting your own trading behavior back to you. When we do it without the documentation, we fool ourselves. We trick ourselves. Our mind plays tricks on us, and we underestimate the number of times we're doing poorly repetitive behavior in trading. We're kind of sort of aware of it, but we don't see it black and white like this, where I say we don't see it green and red like this. When you do it this way, there's no ignoring it. And it's actually kind of exciting to see that you could be making money like tomorrow if you just stop doing these stupid mistakes. Now, here in this last column is where we actually list the specific mistakes we're doing. Okay, all the specific mistakes I did on this day, I would list them here. So let's go back to getting out too soon. So let's say during that day, I got out too soon 4 times. Got out too soon. That looks like a triangle, and that looks like I don't know what. Okay, so, and then maybe twice you got in too early. Oh, I'm so impressive with my penmanship. Okay, so then you'd see that. Then you say, oh wow, I did that more than I thought I did. But then you see it again here. Okay, maybe this day you got out too soon, I don't know, 3 times. And this day you got out too soon 2 times. This day you got out too soon 5 times. This day you got out too soon 7 times. Now, this is the kind of stuff you're going to see. I can tell you from experience. This is the kind of stuff you're going to see. So those 10 commandments, you won't probably have problems with all 10 of them, but you will find what your unique challenges are. You will find, because we're all different. You know, I might struggle with one problem, but you struggle with a different one. This will tell you what your challenges are and your biggest problems. So then you're like, holy moly, I really got, this is the one I got to work on. You know, this getting out too soon thing, that's killing me. That's killing me. I don't need a new indicator. I don't need to buy, you know, this other thing or that thing or this thing. I just need to stop doing that. And if I did, I'd be making money. And you start to see all of a sudden you can't ignore the ramifications of that. And it's just, bam, smacks you. It's like being punched in the face. But it's a good punch in the face because it's going to help you make money. It's actually your friend. Okay, so I'll be happy to send you all those forms. I'll be happy to send you the 10 commandments, all that stuff, just for free. Like I say, no opt-ins or anything even required. Just send me an email, ask for it, and I'll reply to your email. Actually, I'll have one of my people send it over to you. So I do have a special for you today, though. As I said, I'm not selling anything, but I do have a freebie for you. Again, Barry@TopDogTrading.com is my email address. And I want you to get one of my courses. This is really a great, great course, and you're going to get it free. It's a 5-day video. I call it correspondence course. The reason for that is this course is made up of 5 videos, and the topic or the theme of this course is how amateurs trade differently than professionals. So actually, it fits the theme of what we've been talking about today. And we talk about all sorts of things on how amateurs trade, for example, reverse head and shoulders and all things. They think they know what it is, but they really don't. And what the proper reading of a reverse head and shoulders is, and various types of charting patterns, price patterns. And each day, over the next 5 days, you get one video. At the end of the video, there's an interactive quiz that you take right on the video. Actually, it's pretty cool. It's embedded right into the video. Multiple choice questions. And if you get one wrong, it'll give you the right answer, so you make sure you really understood the lesson. On video number 4, not only are you getting a lesson, you're actually going to get one of my favorite trade setups. I call it the rubber band trade. And I trade this to this day. Every time it sets up, I take this puppy because the win-loss ratio on it is fantastic. It's more of a scalping trade. It's not a trend trade. So it's more of a scalp trade, but the win-loss ratio off the charts. And I'm not trying to sell you on that. I'm giving it to you for free. So that comes in the 4th day. Now, next week, I'll be doing another free webinar, and that one I'll be sharing with you my personal cycle indicator. And this is actually a modification of an indicator that's already on your charts. But we make some changes to it, and I'll show you exactly how to make those changes very specifically. And I'll get your chart set up for you. And then I'll show you how to trade it. And the point of the cycle indicator is so that you can nail cycle lows. You buy the final low before the market goes up. Short the final high before the market goes back down. So you don't get stopped out so often. And this thing is amazing. It works very, very well, but it takes an hour to really give you the tutorial on how to use it. So that's going to be next Tuesday. Yeah, next Tuesday the 23rd. So if you get the 5-day correspondence course, which is free, you'll also get the invitation to the webinar. And in that webinar, you don't have to buy the indicator. I'll give it to you. The tutorial on how to use it is free. It's all about how to time your entries and your exits with just amazing precision. So again, no charge for any of that. So anyway, for today's, oh, there we go. Kevin posted it already in the chat box. To take advantage of that, just go to the link that Kevin typed in there, realtraderswebinar.com/top-dog. And we'll get that for you right away. Okay, I see people typing their emails into the question box here. I can't do it that way. I'm sorry. You have to send me an email at barry@topdogtrading.com. I can't download all those emails, so sorry. Yeah, I would if I could, but I can't do it that way. You have to send me an email at my email address, and then we'll respond to it. Okay? All right, my friends. Well, you know what? I don't, unfortunately, have time for any questions now because I have another webinar I have to do, and I have to get prepared for that and get a little bite to eat before I get on there and get my energy level back up. But if you have any questions, please feel free to send me an email. Again, you got my email address there, and I'll be happy to answer any of them. So, Kevin, Mark, everybody at Real Traders Webinar, thank you so much. We had a good turnout today, and thank you everybody for coming, and I hope you enjoyed the lesson today.
Thank you, Barry. And guys, again, definitely go over to realtraderswebinar.com/top-dog. We always get unbelievable feedback from the people that do the 5 videos that he gives, and that indicator is just awesome. And so is the webinar that Barry will do on the following week. So you definitely want to show up to that too. Guys, have a great night. Thank you so much for coming. We will try to get the replay out within the next day or two. And Barry, thank you again for taking the time out of your busy schedule to come and share this great information with us. Guys, go to realtraderswebinar.com/top-dog. And again, thank you for being here, and we'll see you on the next event.